Hello and welcome to Investing with Beauchamp and Bright, IG's investment and markets podcast, where we look at key themes and things that have gone on in markets and predictions for what might come in the next couple of weeks, what might happen in financial markets. Though I should say, this time around, it's not actually Investing with Beauchamp and Bright. Sadly, Aaron, my co-conspirator in this podcast, managed to break his arm cycling very fast down a mountainside. So we wish him very well for recovery. I have spoken to him and he is up and moving about, although very carefully. But we are able to go one better this week because we're joined by Aaron's actual line manager, portfolio manager, Martin Harris. It's the first time on the podcast. So welcome, Martin. Thank you for stepping in.
Thanks for having me, Chris. I think for the listeners, I'm sure we'll have Aaron back soon. And so for his fans out there, we'll get him returning after he's mended his arm.
How was your week, Martin?
Week has been busy. I spent most of the weekend trying to get my hands on some Oasis tickets.
You and everybody else, apparently, apart from me. But
yeah, exactly. I think, after sort of waiting in a queue online for 4 hours, I only managed to get the only tickets left were 2 tickets, about 500 quid each, about 2 miles outside of the stadium. So I didn't end up going for those. And I'll just have to wait and see if I can buy some off some ticket touts.
So we should talk about what's happened in markets over the past couple of weeks since we last recorded this podcast. Of course, we had the big event at the end of August, Jackson Hole, which is where all the world central bankers get together somewhere in the middle of Wyoming, for reasons I always forget, and talk about the outlook for the global economy. And the lesson I think we learned from that was we're about to see a rate cut from the Federal Reserve.
Yeah, I think you're right about that. So it's an academic conference as well. It's incredibly boring. But, at the last Jackson Hole meeting, Powell really went out of his way to basically guarantee that cuts are coming. So he mentioned, he said, the time has come for policy to adjust. So I can't think of anything between now and then that's going to derail this, the rate cuts coming in September. So really, we're just looking at now the possibility of the range of the rate cuts. Some people have mentioned 50 basis points. I think we'd need to see something quite drastic in the unemployment rate between now and then to see a 50 basis point cut. But, as we were speaking about just before we started, these aren't all traditional recessionary rate cuts, needed to fight recession. Instead, these high rates are now just being seen as restrictive to economic growth. And the Fed thinks that they've done enough to ease inflation. And so we're now getting rate cuts that would normally coincide with, stock market falling in a recession. But now we've got almost a good rate cut.
Yeah, because there are two kinds, aren't there? Basically, there are bad rate cuts and good rate cuts. Not all rate cuts are created equal. I think what people forget. So tell us what the difference is really between the two.
Yeah, I think so. As I sort of mentioned, is that typically when your back's up against the wall, you're in the midst of a recession and you have to use rate cuts to stimulate growth, compared to now where there's enough, we can argue that the Fed have achieved their soft landing. There hasn't been a traditional recession and they're now easing off on the rates in order just to stimulate the economy because they have now shifted to an unemployment rate focus. We do expect, as per normal, just with a recession, that these rate cuts would favor the cyclicals that benefit from low interest rate environments. And so those are your house builders, construction companies, household goods, and discretionary goods. Low interest rates will also favor small caps because of their reliance on debt. So this plays a part into this broader rotation that we're seeing in the market at the moment, this rotation away from mega caps into small caps. And that's something that we at IG Smart Portfolios have been buying into, is that rotation into small caps. So that's where we are. And so, yeah, pretty much been looking at charts and data around rate cuts. And when there's no recession, there's a really strong likelihood that we get a positive return in the S&P 500 over a 12-month basis.
And we should talk about, of course, because we're recording this at the beginning of September, so August has just finished. And it was actually quite a volatile month. And surprisingly, most global indices, including the Nikkei, which had those huge falls in August, they finished actually in positive territory. So the thing about August was we had this big sell-off in the first week or so, and then suddenly it was almost forgotten within almost 48 hours, really. I remember people saying in early August that there should be emergency rate cuts from the Fed. The usual suspects that come out and say there should be emergency rate cuts every time it rains came out and said the Fed needs to cut now. and then suddenly that went away again. But it's remarkable how markets took this in their stride, really.
And we didn't see any banks or any hedge funds blowing up, or not that have been revealed yet.
Not yet, anyway. But we're recording this in the week when payrolls takes place. Of course, we'll come to that later on. But you had last month's payrolls, which I'm talking about good rate cuts and bad rate cuts. You had a shocker in payrolls, which were well below forecasts, and suddenly there was this fear that the Fed had got it wrong. They had dropped the ball, and there would have to be rate cuts to really stave off the worst of recession. I think it's remarkable how this has disappeared so quickly. And now we come to the end of August, stock markets in the US and the UK, the DAX is back at record highs, the Dow's back at record highs. As I say, even the Nikkei came storming back from where it was in the lows of August. And it seems like everything's okay again, which is, I think, quite remarkable.
Absolutely. I even remarked to Aaron prior to him breaking his arm, was that I'd been on leave for a little over a week, and I came back and the market had entirely recovered. Had I not looked at the market, you would have not even known that the blip had occurred. So then, explained in 30 seconds, what are rate cuts and what happens when the Fed cut rates?
Rate cuts are when a central bank, in this case probably the Fed, I'm talking about the US, decides to actually reduce the cost of borrowing for an economy. The idea is that if you reduce the cost of borrowing, it stimulates that economy. People can borrow more money at a lower cost. They can look to expand business activity. This applies to consumers and to businesses. And then overall, as we were saying, when the Fed cut rates in a non-recessionary environment like the one we're in now, usually you see stock markets rise, and often the currency of that particular central bank, which in this case, of course, is the US dollar, tends to fall because usually when you have higher interest rates, you see an actual move towards those currencies because you get a higher rate of return when you're investing in those regions. So that's, I think, what you expect to see when we get with rate cuts. So we should move on to NVIDIA. The big event last week, really, earnings, almost the last big player in earnings season, really. It's quite odd how you get the rest of the Magnificent Seven all report at the beginning of earnings season in July and into August. And then we have to wait 3 weeks before NVIDIA, which is now worth an incredible $3 trillion, before this one, the most important one, actually reports earnings. And I think the interesting thing about NVIDIA was that people were hyping this one up as the most important event of the week, almost the most important event of the month. It was as important as, say, payrolls are to the US economy. And yet, okay, the shares did fall around 7-8% in the wake of earnings, but it wasn't a massively volatile event for indices, was it?
It wasn't, and I'm not too sure if you managed to join one of the NVIDIA results parties.
That's the fantastic thing. You've got results parties.
Yeah, I saw some of our colleagues in Chicago had joined some of those on social media. So NVIDIA results have now become a huge economic event. So it embeds this idea that it's now become one of the larger economic presentations, and sits up there with the likes of NFP and so on. I think, as you mentioned, strong set of results, yet the stock price still fell. And I think this is where we'll get into, is about, when things are priced for perfection, what do we expect to see? Typically, each quarter, NVIDIA have been beating expectations in the region of $2 billion. They fell just short of the $2 billion this time, but still beat expectations. A bit of a softer update around their Blackwell chip. That's their new AI-focused chip that they're meant to be releasing. That's got a 2-month delay, but analysts still expect that even with the delay, it's not going to impact their earnings for next year. So their 2025 through to 2026 earnings are not impacted by this delay. But certainly that sort of softer update is what led to some of the contribution to that fall.
Yeah, I think this is the key thing with NVIDIA is how you sort of cope with a stock that it's riding so high. There's so many high expectations of what NVIDIA will continue to do. What it's done over the past 2 years is incredible. But where does it go now? I think Bloomberg are reporting that 1 in 3 NVIDIA staff members are now, because they hold stock in the company, they're now millionaires. It had a nice line pointed out that if you looked at the car park underneath NVIDIA headquarters, the number of high-end cars, Lamborghinis kind of thing, was now beginning to multiply. So clearly people are spending their winnings. That the problem is, of course, if you leave, you lose some of that stock. But that's another matter. It's, in fact, how do you accurately assess the outlook for a company that is up by what, even pre-split, a sort of 1,000% in 2 years? And it's a question that I often get asked when I deal with the media and with investors. Is this company had a really good earnings report? why did it fall? And I think you often see the answer is what happens to the share price before before the release, if you like. You're seeing people investing into the stock in the days and the weeks beforehand, and then suddenly on the earnings day itself, it's not that suddenly there was something terrible in the figures. And NVIDIA's numbers are huge, and they look towards even better growth, I think. But it's the fact that you already had that rally. I think you say a stock rally is 10-15% into earnings, it can't sustain that momentum in the immediate aftermath of the result, can it?
Yeah, and I think this entire AI mega trend has been quite overdrawn to some extent. However, we are still seeing this in a positive light. I think the capex around AI computing is set to continue. We've seen CFOs and chief intelligence officers coming out, or chief information officers rather, coming out and indicating that 5% of their tech budget is going to be spent on AI hardware computing going forward. And we should see that actually increase to about 15% in the next few years. NVIDIA have a client book that the envy of all, I think 7 of their clients are the biggest companies in the world. And so really we're seeing this huge capex spend in the AI space. And something that's been spoken about a lot is, the people who are at the picks and shovels of side of the AI boom really are the beneficiaries. So we're seeing the data centers, we're seeing the optical component companies, the likes of Coherent, Fabrinet, Lumentum, and then all of the data center companies really benefiting. So Dell, Supermicro, HP Enterprise are the beneficiaries of this AI boom. We're also seeing now NVIDIA move into competing with some of challenging some other incumbents in the sector, the likes of Arista Networks and Cisco. And so really the disruption that AI is potentially going to cause is still what that momentum is playing on. So we don't yet have any hard numbers as to what AI delivers, but certainly in the hardware space, there's been a huge spend, and we continue to expect revenue to increase. I think just if you look at the PE ratio on NVIDIA, there's an expectation that their revenue is still yet to double in the next few years.
It's astounding, really. And as you say, it's got so much further to go, really. I think you will see ups and downs in the share price. We were talking about this last time. You had a big drop in July and August from those record highs, but it hasn't changed the overall direction of travel, certainly for the stock price. And if the expectations are anything to go by, it certainly hasn't changed the direction of travel for that revenue forecast either. So definitely, I think it's still one that will continue to dominate. And because there's such a big part of the market cap, the S&P, and the weighting, tech stocks, their importance isn't going to change, I think, in the near term. But we should talk about what's coming up in the next couple of weeks, really, because we're back in September. If you like, normality has been resumed in markets after the August lull. That was certainly the case the last couple of weeks, really. So the first thing that we've got on the radar, well, we have payrolls on Friday. We should mention that for starters. So that's the first event, because August's payrolls were so key for that market sell-off because it was so poor. But we're looking for a rebound in those payrolls in this week on Friday, so it should improve. But the other thing to watch, funnily enough, talking about the Fed and they're going to cut rates. Actually, the first up this month is the European Central Bank, the ECB.
I think looking at the ECB, slightly on the back foot compared to where they'd like to be. They did give that 25 basis point early cut. And that was really on this idea that they had hiked slightly too much and they could take some off the table. I think that, BOE and the ECB have been waiting on the Fed to start cutting. That's been delayed. So I think we're going to now start seeing a somewhat aggressive cutting cycle from the ECB now that the Fed have indicated that rate cuts are on the table.
Yeah, and I think if you look at German data, it certainly justifies it. It's been very poor performance from the Eurozone's most important economy. I think that's the key thing the ECB should be worried about, really. And given that the Fed has essentially cleared the runway for that rate cut in the following week, that's the third week in September, around the 17th, we should see probably the ECB maybe begin even to move as well. But there's something else to really get markets moving, hopefully, anyway, which is to go back towards tech stocks. It's that Apple iPhone release.
That's right. So they're going to have their iPhone update presentation on the 9th of September. And the big news there is that Apple have been working with OpenAI to integrate some sort of an embedded AI assistant into the new iPhones. And
there's just no escape from it, is there?
There's
as
no
soon as you get AI into something, then
so now AI is going to be planning your calendar. It's going to be making bookings at restaurants for you. It's going to be replying to your messages. And this is the idea that if this delivers, we could see a new super cycle in sales for iPhones. If it doesn't, we might see exactly what we saw with NVIDIA, a large sell-off straight after the announcement if it's disappointing. So that's going to be something to watch. I think why they're expecting this super cycle is that because this the older iPhones don't have the computing power to handle AI. It's not compatible. It's not compatible with anything prior to the 15 Pro. Data coming out from Apple shows that they've got 300 million phones that are more than 4 years old, and so they already, Dan Ives from Wedbush Securities is indicating that they're expecting early orders of 250 million units of the new iPhone. And I think really what that puts us into is, a new super cycle in sales for Apple. The iPhone represents 46% of revenue, and it's been slipping. So services has become a larger item of revenue. iPhone has been slipping down. What we could see is iPhone coming back to the forefront as their revenue spinner.
I think this is a really good thing for Apple share price, actually, because as you say, for a long time it was all about the iPhone. And then over the last few years, it was the idea that you could be drawn into the Apple ecosystem. I say this as a devoted Android user. So I've avoided that. But it is that idea that you're not just using the iPhone, you're using the products. But it's really interesting. You've got these people who, because around all these events, there's a sense that everyone always upgrades their iPhone every time. But it's actually, as you say, it's not the case. But if you get the AI in there, it could be the hook that drives this adoption of the new model and gives Apple, I think, that the shot in the arm it's been looking for. Because if you look at the share price return, okay, it's up 23% so far this year, but that's well behind NVIDIA's modest 147% gain in its share price. So in one sense, it is lagging, and that could be a bit of a game changer.
Yeah, absolutely. And I think they also had that, recent news that Warren Buffett had halved his position in Apple. There's a few new hedge funds
booking a modest profit, I think, there.
A few new hedge funds buying in. So this could kickstart the next sort of wave of share price accumulation.
Could be another interesting time, the Magnificent Seven, as we head into, of course, the next reporting season, which actually begins amazingly. I was looking at this today. JP Morgan reports about the 11th of October. So we're not that far away, sadly, perhaps, before the next reporting season does roll around. So that way could be an interesting one to watch when Apple reports, probably second half of October, I think. Yeah. And then we should go on to our one of our features for the podcast, are On This Day. We try and find key events interesting from history. And we should note, last time around, and we only found that this after we recorded the podcast, so we failed in this front, that we actually recorded it on George Soros's birthday. So that was quite interesting back in August. But unfortunately, we did miss that one. But I did look for some relevant finance ones for this time around. There wasn't anything. Though I should know it is Keir Starmer. His birthday today, our relatively new UK Prime Minister. That's one to watch. But on a finance basis, it is the anniversary of Google Chrome being launched in 2008. So there's no getting away from tech stocks and Magnificent Seven. So that's certainly one of the great rival to Internet Explorer, certainly the one that's displaced Internet Explorer. I do know I've always just switched over to Chrome entirely. I don't know whether you're a Firefox or an IE or a Chrome.
I haven't looked at Firefox for 10 years.
But then the other events we were looking for, first it's the anniversary of the Great Fire of London, starting back in 1666. So there's one particularly for the UK. And also one I wanted to mention, you can tell these ones are drawn up by me because they're all historians ones, but 1752, this is for the nerds out there, was the day of the calendar change in what was then the UK, United Kingdom of Great Britain. In 1752, they switched over from what they called the Julian calendar to the Gregorian calendar. And in this process, they lost 11 days. So they woke up one day and it was 11 days after the previous day. And this caused a lot of complaints amongst the ordinary people of the UK because suddenly they'd lost 11 days. So one thing to watch for there. I don't think we're expecting any calendar changes, but certainly it must have been quite a bit of a major event. So those, I think, the key ones to watch for, or the key ones on this day in history, Great Fire, and then that calendar change. We'll see next time. I think we'll see what other events we can come up with. But thank you, Martin, for stepping in Aaron's absence, and thank you everyone for joining us for this podcast. Hopefully next time Aaron will be back, recovered or somewhat recovered from his injuries.
Yes, thank you for having me. And yeah, hopefully Aaron's back with the use of both arms.
Yeah, thanks very much for joining us, everyone. And we'll see you again next time.